Revenue growth at HIMS and HERS Health went from 4% year-over-year in Q1 to 38% in Q2. That is a dramatic reacceleration. But in the same breath, earnings per share collapsed 318% year-over-year, swinging from a profit to a loss of 37 cents. So the real question is not whether the top line is moving. It is what they had to spend and borrow to make it move. Q1 2026 was an alarm. $608 million in revenue, up just 4% year-over-year, gross margin falling from 73% to 65%, and a net loss of $92 million against a $49 million profit in the same quarter a year earlier. Management called 2026 a defining year and pivoted toward branded GLP-1 products. Then Q2 delivered $753 million in revenue, up 38% year-over-year, with subscribers near 2.6 million, up 9%. The top line answered the skeptics. The bottom line did not. Net loss in Q2 was $86 million, and operating margin sits at negative 11%. The Q1 earnings release raised full-year 2026 revenue guidance to a range of $2.8 billion to $3 billion. Implying the back half needs to sustain this reacceleration. In May 2026, HIMS and HERS priced $350 million in convertible senior notes at 0% interest due 2032, upsized from the originally announced $300 million to fund international expansion and artificial intelligence platform investment. In June 2026, the company completed the acquisition of Eucalyptus, an international telehealth platform operating across Australia, Canada, Germany, Japan, and the United Kingdom. Management tied these moves explicitly to a long-term target of $6.5 billion in revenue and $1.3 billion in adjusted EBITDA by 2030. Here is the causal chain as the research reads it. Compounded GLP-1 drugs drove a revenue surge in 2025. When that tailwind compressed, gross margin dropped 8 points. HIMS and HERS pivoted to branded GLP-1 and international expansion to find the next growth layer. Eucalyptus adds 5 new markets. The convertible notes fund the bridge. Subscriber scale, now nearly 2.6 million, is the lever management is pulling to justify the spend. The bet, a closed-loop consumer health platform at global scale, eventually converts that subscriber base into durable margin. The industry context here is not favorable. AlphaOS scores the drug manufacturer's specialty and generic industry at 33 out of 100, flagging a contraction cycle with neutral momentum. That is the sector backdrop, while HIMS and HERS Health is absorbing a fresh acquisition, carrying $350 million in new debt and running at negative 11% operating margin. If subscriber growth or GLP-1 demand softens before international operations scale, the cost structure has limited room to flex. The 10Q filed August 10th flags forward-looking risks explicitly, and the filing tone is neutral, not confident. AlphaOS surfaced the earnings per share deterioration of negative 318% year-over-year alongside the revenue reacceleration, a divergence that would be easy to miss in a headline beat. The platform also flagged the insider buying signal from the August 2026 10Q and the contraction cycle industry score, giving that cost structure risk a quantified backdrop. HIMS and HERS Health is competing in a space where CVS Health and Cigna are peers by industry classification, traditional healthcare giants with entrenched distribution. Eucalyptus now makes this a multi-continent operation, putting it up against local telehealth players in 5 new markets simultaneously. Guardant Health is another named peer in the research graph, signaling the market sees HIMS and HERS Health drifting toward diagnostics and longevity, categories that carry their own regulatory and reimbursement complexity. The $6.5 billion revenue target by 2030 requires roughly 9x the current quarterly run rate. That math demands the international bet to land cleanly. 3 things to watch. First, gross margin trajectory. If it cannot recover from 65% back toward the 73% range as GLP-1 mix shifts, the 2030 EBITDA target does not close. Second, Eucalyptus integration speed. 5 new markets acquired at once is operational complexity that can quietly erode the subscriber economics that make this model work. Third, the convertible note conversion threshold. $350 million in zero-coupon debt due 2032 is manageable if growth holds, but it is a structural liability if the revenue ramp stalls again like it did in Q1. The full research on HIMS and HERS health, earnings prints, filing signals, industry scores, and the dependency graph is live on AlphaOS. Open it at alphaos.finance. Research and analysis only, not investment advice.